Welcome back to the channel, everyone. Today I want to explain how Goldman Sachs are hiding the failed to delivers, and how if the apes keep up our current trajectory, we could cause an AMC share recall, which would almost definitely cause the AMC short squeeze. So stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 3,400 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already so that you don't miss another video just like this one. But before I dive in with the key information, I've actually got a big announcement towards the end of the video that I actually need your help with. So be sure to watch to the end and let me know what you think down in the comments below. And now I want to dive straight in with the key information. So, Goldman Sachs provides borrowing and lending services to allow institutions to cover their short positions, aka they are volleying the same shares between each other to reset the failed to delivers. This post on Reddit then comes with the attached photo, but it's quite hard to see, so I managed to find the source of this article published by Goldman Sachs in their 2021 resolution plan. Equities financing includes prime brokerage and other equities financing activities, including securities lending, margin lending, and swaps. We earn fees by providing clearing, settlement, and custody services globally. In addition, we provide our hedge fund and other clients with a technology platform and reporting that enables them to monitor their security portfolios and manage risk exposures. We provide services that principally involve borrowing and lending securities to cover institutional clients' short sales and borrowing securities to cover our short sales and to make deliveries into the market. In addition, we're an active participant in broker-to-broker securities lending and third-party agency lending activities. We provide financing to our clients for their securities trading activities through margin loans that are collateralized by securities, cash, or other acceptable collateral. We earn a spread equal to the difference between the amount we pay for funds and the amount we receive from our clients. We execute swap transactions to provide our clients with exposure to securities and indices. So basically what that's explaining is that Goldman Sachs provide a service to other hedge funds, market makers, and just generally other institutions to cover their short positions, as in to cover their failed to delivers. Or more than likely, they just borrow stock from Goldman Sachs in order to make deliveries into the market. As in just to show FINRA, look guys, we got some stock, so we're delivering it so we don't have those failed to delivers anymore. But in reality, all they've most likely done is created another failed to deliver just with Goldman Sachs in order to reset the clock. I'm sure there's other brokers or other large banks that engage in these practices as well, giving the hedgies an opportunity just to swap their failed to delivers with another firm. But there's two reasons as to why this can't go on forever. It's because the hedge funds actually have to pay Goldman Sachs a fee to provide this service. I imagine that fee is going to be fairly large and a percentage of the overall failed to deliver position, say like 0.5% or 1%, 2% or 5% for example. Because obviously Goldman Sachs is taking on a lot of risk by holding those failed to delivers or by engaging in a buy-right transaction with them. Again, I've explained buy-right transactions in one of my other videos, but it's effectively the process they use to juggle the failed to delivers between the two parties. But both parties are actually exposed to risk, and therefore that's why Goldman Sachs charges a fee for it. But in addition, Goldman Sachs also provide financing to our clients through margin loans, and those margin loans are obviously going to cost money. Therefore, as the hedgies are currently digging their position deeper and deeper and deeper, they're going to be taking on more and more and more in terms of margin loans, and therefore their interest and overall fees are going to go higher and higher and higher. Yes, the AMC cost to borrow fee is fairly low, say between 0.1% and 1%, but that's just the cost to borrow fee, not including any fees that are being charged by Goldman Sachs for these margin loans. And in addition, as that hole is dug deeper and deeper and deeper with short positions, the cost to borrow fee will go up as utilization gets closer to 100%. And I think a recent post from Peter Han explains that really well. He says, nonetheless, the overall spirit of the community is strong. The recent sell-off to $29 continued to see strong retail buying. And I really have to question, what is the point of just adding more shorts to an already impossibly large position? Latest data from the AMC Shareholders Question Survey is showing actual float is over 1 billion shares by the most conservative estimate, on the higher side 5 billion or more. And that's exactly what I've been trying to explain. The hedgies have been digging this hole deeper and deeper and deeper. The hole's not just going to magically disappear and they're not going to magically get out of it. At some point they will have to cover. And as I've said before, yes, they can continue beating the AMC price down to $25, $20, or $15, but to do that, they're having to short more and more and more shares, and therefore digging the hole deeper and deeper and deeper. And therefore, when they do cover, the AMC share price is going to shoot straight back up to $70, and they'll have only covered a small portion when that happens. They'll be back at square one. They've effectively taken 2 steps forward and 2 steps back. By doing this, they haven't actually ever covered any of their original short positions, they've just covered the new positions that were used to beat the AMC stock price down to whatever price they beat it down to. They still have all of the original shorts still to cover, back up at $70. So I also wanted to discuss how we could effectively cause a forced share recall. The current update from the Say Technologies platform is 48,300 votes, around 1% of the apes, to 56.1 million shares, around 10% of the float. So therefore 1% of apes hold a whopping 10% of the float already. Also, don't forget that this number doesn't include any institutions, and also at the moment currently doesn't include a lot of people from the UK, Europe and Canada that can't yet register to vote. This still gives an average share per ape of 1,161 shares, which is absolutely incredible. These votes are continuing to climb, but the average is not falling. Yes, you could argue that a lot of apes that only own 1, 2, 5 or 10 shares haven't been voting, and therefore on a straight average it's obviously overestimating, but that's why you'd use something like an 80-20 principle, or a 94-6% principle, or even a 99% or 1% principle. Whatever you use, it still shows that there's more shares in issue than 513 million shares. As this figure climbs higher and higher and higher and closer to the full float of shares without being anywhere close to 4.1 million apes, it will effectively enact a forced share recall. The lenders won't be able to ignore it any longer and will have to forcibly recall the shares. This is something similar to what happened on KBIO that caused the stock price to squeeze from around $1.90 all the way up to $40 to $45. Calobio's KBIO Infinity Squeeze. In November 2015, Pharma bro Martin Shkreli orchestrated a violent short squeeze on failed biotech Calobio's that caused its share price to rise by a staggering 10,000% in just 5 trading days. KBIO had been perceived by short sellers as a no-brainer, near-term zero. KBIO's only real drug had just failed and the company had insufficient cash to pay over $6 million in debt. Lesson number 1. Fundamentals do not matter. Period. In early November of 2015, KBIO was an utterly defunct, failed biotech clearly headed for insolvency. KBIO had just one single feasible drug in clinical trials at the time and had no revenues. When that drug failed, KBIO was left with an insufficient cash to pay nearly $7 million in debt. KBIO quickly slashed headcount by 61% and then publicly announced that earlier hopes of pursuing strategic alternatives would not be viable due to having such limited cash resources. Then on November 17th, 2015, the Nasdaq notified KBIO that the stock would be delisted because it had failed to file a 10Q for the September quarter. So to be clear, KBIO's problems were catastrophic and unfixable. Way worse than AMC at the moment, as AMC is actually quite a successful company and with the reopening is doing record-breaking numbers. After the close of markets on November 18th, just one day after KBIO received its delisting notice, KBIO announced that an investor group led by Martin Shkreli had just acquired more than 50% of KBIO shares, so that's why the share price had spiked from 44 cents to around $2. When the market opened the next day, KBIO skyrocketed from $2 to over $14 on staggering volume, as terrified shorts scrambled for the exits. After the close on November 19th, KBIO released a second announcement, stating that the group had now acquired a full 70% of outstanding shares and that Shkreli had been appointed as KBIO's new CEO and chairman. Shkreli's group had stated that it would inject an initial $3 million in cash with an additional $10 million following shareholder approval. By November 23rd, KBIO had briefly hit $45 per share. Phase 2. Forced borrow recall. After briefly hitting $45, KBIO quickly retreated into the $20. After all, it was still just a defunct biotech stock without a real drug. Even with a bit of cash from Shkreli, the stock was worth nowhere near a market cap of over $200 million. Short sellers piled in to short more in the 20s on the basis that it was just a squeeze, and that would quickly fall apart. And that's exactly what's happening with AMC at the moment. We own over 70% of the float. over 80%, potentially even over 90% of the float, and short sellers are piling in because it's just a short squeeze and the short squeeze is over. Obviously, that was sarcasm. As KBIO's share price had been spiking, short interest had been growing, like we're seeing in AMC, and Shkreli now owns 70% of the outstanding shares. Then on Thanksgiving Day of 2015, when markets were closed, Shkreli tweeted that he had decided to recall his KBIO shares that had been lent out to short sellers. The resulting squeeze was just a simple math problem. When Shkreli recalled his shares, brokers would be forced to buy in the short sellers, causing it to spike uncontrollably. When the market reopened on Black Friday for a shortened session, shares of KBIO continued to squeeze higher, reminding some investors of the Volkswagen Porsche Infiniti squeeze from 2008. Shares surged 31% as shorts trampled over one another to close their positions. The stock again surged back to as high as $45 and remained elevated for weeks thereafter. Key takeaways from KBIO's Infiniti squeeze. The ability to say "I told you so," as in "I told you so, it was just a short squeeze, AMC is still going down." 6 months down the road has precisely zero value, especially for traders who went broke in the process. Basically, after AMC squeezes and comes back down, it will be worth zero value for hedge funds to say "I told you guys, it's coming back down now," after they've all gone bankrupt. When shorting any stock, it's important to know who's on the opposite side of the trade and what they might be capable of. And guys, us apes are on the opposite side of that trade and we are capable of a lot. Easy to short does not always equate to easy to cover. As late as November the 16th, short interest in KBIO had stood at less than 6%. The cost to borrow shares was not excessive. The sudden double whammy of rising short interest against the sudden change in availability of float is often easy to miss. The fact that Martin Shkreli ultimately came to an unpleasant end, as he was arrested for something completely different, does nothing to reverse the losses of those who were on the wrong side of the KBIO squeeze. And guys, that's going to be the hedgies. Now guys, before I leave you today, I want to give you my special announcement. From the bottom of my heart, I am very, very thankful for all of the people that have subscribed to the channel, ding that notification bell, watch all of my videos, and who have recently joined the Patreon. And to say thank you to you guys, I really want to do a giveaway. I was thinking $500, $600 or $700, but I don't really know what to give away. I was thinking maybe just an Amazon gift card or an expensive whiskey, but I don't know how difficult it is to ship whiskey from the UK to the US, or maybe some of the Apple headphones, but I don't really know. So leave a comment down below, let me know what you think I could give away for between $500 to $700. And guys, I also wanted to let you know that I've just released some AMC related merch. It should just be below the video, but like before the description. So if you want to pick up some cool AMC merch and support me at the same time, then check it out. I've got 5 different designs, some t-shirts, some hoodies, and other bits and pieces as well. And guys, as always, be sure to leave a comment down below. Let me know what you think of Goldman Sachs hiding the failed to delivers. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.